Hey everyone, welcome back to Corporate Decoder, the place where we try to stay ahead of the curve, and maybe even get a little rich doing it. Today we're looking at Wintergreen Acquisition Corp, and let me tell you, some of the numbers here are quite interesting before we dive in. If you like getting clear, no-nonsense breakdowns of these filings, make sure you subscribe. And if you want to chat with us about these companies and get even more insights, join our Discord community linked in the description. So what exactly is this filing about? Well, it's a current report or an 8K filing with the Securities and Exchange Commission, which basically means something important happened that the public needs to know about right away. And for Wintergreen Acquisition Corp, the big news is about their capitalization, meaning how their ownership structure and the different types of stock they have are set up. Think of it like clarifying the ingredients list on a fancy cake before you take a bite. Now, Wintergreen Acquisition Corp is a company that's in the business of acquiring other companies, often called a special purpose acquisition company or SPAC. These companies go public to raise money and then search for a target business to merge with or buy. It's a way for private companies to become public more easily. Let's see what's going on with their shares. As of August 1st, 2025, the company had a specific number of ordinary shares outstanding. Now, what does that mean? Ordinary shares are just the basic kind of stock you'd buy if you were a regular investor. The par value $1 is a very small nominal amount that has little to do with the actual market price of the stock. It's more of a legal technicality. And here's where it gets a bit more interesting. When we look at the total ordinary shares outstanding, assuming all the units are separated into their constituent parts, the company reports 7,300, 3,575 shares and 575 shares now to Fedsi Toti 95,000 of these shares are subject to possible redemption. What redemption means in this context is that the holders of these shares might have the option to exchange them back for cash, usually at the original price they paid for them before a merger actually happens. This can be a pretty big deal for a SPAC because it directly affects how much actual cash is available for a future acquisition and how many shares will be left to represent ownership in the new combined company. So, if 5,595,000 shares could be redeemed out of the total 7,035, that's a significant portion. This tells us a lot of investors in this SPAC might be waiting to see if they get a good deal before committing to the acquisition, or they might be ready to cash out if the deal isn't to their liking or if they just want their money back. This high redemption possibility can create uncertainty for potential acquisition targets and for the future performance of the combined entity. It's like holding a ticket but not being sure if you're going to use it for the show or just get your money back. When we look at the different types of securities, we see ordinary shares and rights to acquire more ordinary shares. The filing also specifies the currency involved, which is US dollars, the standard for most of these types of companies. The mention of expiry shares confirms we're dealing with share counts in the financial reporting. Even though we don't have a huge table of numbers here, just understanding the breakdown of outstanding shares and those that might be redeemed is crucial for anyone looking at this company's potential. The filing also details the components of their units. A unit typically includes a share and a warrant or a right to buy more shares later. In this case, each unit consists of one ordinary share and one right to acquire 1/8 of an ordinary share. So if you bought a unit, you got one basic share and a piece of a right to acquire more shares. This structure is common in SPACs to make the offering more attractive. Now, something else that happened was on July 13th. Mac Dream Holding Limited, which is identified as the sponsor, actually forfeited some shares. They gave back 38, says it's because the underwriters, the banks that helped sell the shares initially, used their option to buy extra shares, known as an overall allotment option, and this forfeiture is a consequence of that. For the sponsor, forfeiting shares can happen for various reasons, but in this context, it's tied to how the initial offering was managed and the underwriters' actions. It's a bit of a technicality, but it affects the total share count as well. It's also worth noting that Wintergreen Acquisition Corp securities are listed on the Nasdaq Stock Market LLC. This means they are traded on one of the major stock exchanges, which generally implies a certain level of transparency and regulatory oversight. Their trading symbols are WGU for units, WG for ordinary shares, and WGER for the rights. The company also identifies itself as an emerging growth company. This is a designation for companies that have earned less than a certain amount of revenue in their most recent fiscal year. Being an emerging growth company allows them to take advantage of certain exemptions from regulatory requirements, like reduced financial reporting and disclosure obligations. It's a way to ease the burden on newer companies as they are developing. So what do we make of all this? Well, Wintergreen Acquisition Corp is clearly in the process of defining its future, likely gearing up for an acquisition. The key takeaway from this report is the clarity on their share structure and the significant portion of shares that might be redeemed. This high redemption potential is something potential investors and acquisition targets keep a close eye on. It can affect the valuation of a deal and the amount of cash that actually flows into the combined company. If a lot of shareholders choose to redeem their shares, it reduces the amount of capital available for future growth or acquisitions, which can be a drag on performance. In essence, this filing is a snapshot confirming how many basic ownership stakes are out there and how many people might be asking for their money back. It's a detail that provides a clearer picture of the financial landscape this SPAC is navigating. It's not a report that shows profits or losses from operations, but rather the structural underpinnings of the company itself. Companies like this are all about the future deal they will make. The success of this SPAC will hinge on the management's ability to find a good company to merge with and to structure a deal that is appealing to both the shareholders of the SPAC and the company being acquired. Now, looking at these numbers in the broader context of SPACs, a high redemption rate isn't necessarily a bad thing, but it does indicate a more cautious or perhaps less committed investor base at the time of the SPAC's IPO. Management's skill in finding the right acquisition target becomes even more critical when faced with potentially fewer remaining funds due to redemptions. The ultimate success will be judged not by these numbers alone, but by the quality of the merger that follows. Alright. That's our breakdown of Wintergreen Acquisition Corp's latest filing. What's your take on these share numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.